Dear students, hello. I am Professor Edward and I am here to share an important insight with you about the stock market. The most profitable individuals in the stock market are those who only buy stocks through concentrated position building and never get trapped by market manipulators. Let's first look at a model from game theory called the smart pig game. In a pig pen, there are two pigs, a big pig and a small pig. On one side of the pen, there is a pedal. Each time the pedal is pressed, a small amount of food drops into the feeding tube on the other side of the pen. If one pig presses the pedal, the other pig has the opportunity to eat the food that drops. So when the small pig presses the pedal, the big pig eats all the food before the small pig can reach the tube. So if the big pig presses the pedal, it has a chance to eat its share of the food before the small pig finishes. Now, the question is, what strategies will the two pigs adopt? The answer is, the small pig can only wait by the tube, while the big pig tirelessly shuttles between the pedal and the tube. In this model, there is a rule. The smaller pig, the easier it is to start and starve. In this analogy, the big pig represents the market manipulators in the stock market, while the small pig represents retail investors. So in this game, retail investors should not attempt to press the pedal, as it is prerogative of the market manipulators. When retail investors can do is to seize opportunities and patiently wait by the tube. As the saying goes, those who understand the current situation are the wise. So retail investors should go with the trend and speculate on price differences to have a better chance of making money. Therefore, this game can be transformed into a situation where market manipulators fully utilize their advantages to discover or create stocks with growth prospects, while retail investors either inflate stock prices or simply ride the wave, which results in a win-win situation. So although it's difficult for retail investors to defeat market manipulators, they can still get a piece of the pie from the market manipulators' feast. So the power disparity between retail investors and market manipulators turns this into a competition between amateur players and professional players. So many people have achieved success in the stock market but are exhausted, living from hand to mouth, unsure of where future profits will come from. So if you want to invest effortlessly and become an evergreen tree in the stock market, you must establish a profit model that can adapt to changing circumstances and create miracles in the capital market. So while Warren Buffett's value investing may not be suitable for everyone, his decades-long use of the same profit model is worth learning from. Buffett has created immense wealth, yet he remains relaxed and has not established a large research team because he has built his own profit model. His job is simply to replicate his model and let it earn money for him. Establishing your own profit model is a sign of maturity for an investor and the ultimate goal for the investors to pursue. So in real stock market trading, people often ask, when did the market manipulators start building positions in a stock? Have they finished building positions? Why would they dump shares after building positions? If you were asking these questions during the early developments of the securities market, it would mean you were a challenger to a new thing. If you are aware and are still asking these questions now, it only shows that you are a new stock investor who has no understanding of market manipulators. Why do I say that? Well, in a broader sense, all actions of buying chips can be called building positions. But strictly speaking, building positions refers to the behavior of market manipulators who absorb a large number of low-priced chips in order to speculate in the future. Therefore, building positions is a behavior of market manipulators. Retail investors generally lack the ability to manipulate stock prices. Market manipulators, on the other hand, can manipulate stock prices by absorbing a large number of low-priced chips and then taking a series of actions to make the stock price rise or fall, thereby obtaining profits from the price differences, and that is how only market manipulators have the ability to manipulate stock prices. At the same time, market manipulators also engage in high selling and low buying operations, allowing them to profit from price differences and reduce their holding of costs. Therefore, sometimes stock prices have nothing to do with market manipulators. As long as there is an opportunity, market manipulators will engage in price differentials and still make profits. Retail investors cannot engage in price differentials for a long time, nor can they easily manipulate prices. Now, by joining the concentrated position building project of institutions, you become a true market manipulator, collectively controlling the stock market. If you still have questions or need further clarification on this topic, feel free to ask your personal assistant. Remember, making money is all about learning. If you are willing to sacrifice time, you could be the next one to embrace wealth. Thank you.